Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robot trading software for free. Now, let's look at tax loss harvesting. Now, what is tax loss harvesting? This is a practice of selling a security that has experienced a loss. By realizing or harvesting a loss, investors are able to offset taxes on both gains and income. The sold security is replaced by a similar one, maintaining an optimal asset allocation and expected returns. Tax loss harvesting is an opportunistic way to increase your post tax returns on investment. Even through an indirect way, tax loss investing can help you maximize wealth accumulation, especially in the beginning of life of a portfolio. Whenever you invest in equity funds, you make capital gains. These capital gains are taxable based on how long you stay invested in that fund. Tax loss harvesting is used to reduce tax liability on investments. In tax loss harvesting, you sell your stocks or fund units at a loss in order to reduce your tax liability on capital gains. It is a method to offset the capital gains made on equity against the capital loss suffered to pay lesser amount of tax. Now, how does the tax loss harvesting work? Most of the investors prefer using this strategy at the end of the financial year when they need to file returns, but you can use it throughout the year in a planned manner to keep your capital gains at a relatively lower level. Tax loss harvesting starts with the sale of the stock or an equity fund which is experiencing a consistent price decline. You feel that the security has lost most of its value and chances of a rebound are bleak. Once the loss is realized, you offset it against capital gains that your portfolio has earned over the period. For example, suppose in a given financial year, your portfolio made a short term capital gain and a long term capital gain of rupees 1 lakh and 1 lakh and 5,000 respectively. So the short term capital losses were rupees 50,000. So without the tax loss harvesting, the tax payable would be the 1 lakh would be 15%, and for the long term capital gains, the tax would be 10%. So if we calculate the tax payable without the tax loss harvesting, it will be rupees 15,500. Now let's include the tax loss harvesting. So if we the short term capital losses were 50,000, so we can reduce that from the short term capital gains. So the 1 lakh will become 50,000. So the tax will be 15% for that amount. And then the long term capital gains will have the same amount of percentage. So the tax payable in the end will be rupees 8,000. The amount realized from the sale of the loss making the stock or the equity fund can be used to buy a lucrative stock or equity fund. This kind of replacement is necessary to maintain original asset allocation of the portfolio. Moreover, it keeps portfolio's risk-return profile intact. Among other measures, the tax loss harvesting is an important tool to save a lot on taxes. Additionally, you get to know ways to diversify your portfolio to earn higher returns. It doesn't help to nullify the losses, but it can definitely reduce your suffering by helping you save taxes. So let's look at the photo on the side here. You can get another idea of how it would look. So here we have the sale of Fund A and the sale of Fund B. So the Fund A gave you a 30K gain and the Fund B gave you a 15K loss in dollars, but so the net gain is $15,000 net gain. So for the tax, with the tax loss harvesting, the tax owed will be $2,250. Now let's look here. If we look at only the capital gains, here is $30,000, and with the tax, you'll have to give $4,500 as tax. So you can see how much the difference is there with the tax loss and without the tax loss harvesting. Now, things to keep in mind while using this method. While setting off losses using tax loss harvesting, you need to keep the following points in mind. The long-term capital losses can be set off against only long-term capital gains. You cannot set off long-term capital losses against short-term capital gains. The short-term capital losses can be set off against either short-term capital gains or long-term capital gains. Thank you for watching this video. For more videos on stock market trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. Once you've uploaded the required documents, your account will be activated soon. You'll also get intraday recommendation calls and you can learn robo trading software for free.